Welcome to my channel. I'm the cover call guy. My goal is to hit $120,000 per year in passive income using only cover call ETFs. My portfolio currently yields $70,000 and about $6,000 a month. Legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I am just some random idiot you found online, and I could be completely wrong, so please do your own due diligence. With that out the way, let's get started on today's video. Today's market, everybody was screaming it was a market crash, and it took a I was looking and reading on the news and seeing everybody screaming how they're red in they're red today. They're down. I'm down myself. But this is my red day playbook. Don't worry, it's just a little dip. Okay, we love dips. All right, dips is how you create generational wealth. This is how you get generational wealth opportunities. Days like these, we need to appreciate the red days. We should learn to love the red days. I personally love red days. I love it when the market tanks. I love it when the market takes a nice dip. Today was special, however, and we'll go through it. It was special because you'll see in my video. All right, stay tuned and you'll see. All right, the strategy that I'm gonna be using, right, the dry powder principle, reframes cash not as idle asset but as a strategic tool for defense, preventing forced sales and offensive, capitalizing on discounts. It is your fault if you cannot buy the dip. Why? Because you should always have some dry powder on the side. Don't just use everything with dollar cost averaging and every single time. If you're up, maybe have some of that money on the side just in case for dips and down days like today. My central thesis: market downturns are not risks to be avoided, but the primary mechanism for building generational wealth. Right? The April tariff crash. Oh my! I loved it. I dropped like almost $40,000. Right, I went and bought the dip as much as I could. Obviously, I didn't want to spend everything. Maybe I should have, hindsight. But I like to have some cash on the side. April tariff dip was one of those. And today was a small little dip. It was a little special in a way. We'll get to it, but it was a little special in a way where everything was on sale, and we'll talk about it. The playbook, right? So this report provides about 79 actionable strategies grouped into 5 categories to turn fear into long-term financial advantage. It was 79, but I actually took it down a little bit more. I felt like it was a little too long. I just forgot to change the number, but it went from like 40 slides to like maybe like 17. So I just kind of combined it. It is like 70 actionable strategies. I just kind of grouped it more together. So that way I'm not talking for an hour. All right, the anatomy of a market-wide drop. The sell-off. This is why it was actually kind of special today, right? All 3 major index fell, especially Bitcoin. It is now below $100,000 and is not recovering right now. So we have to see. This is a good buying crypto opportunity for myself, because I love Bitcoin, right? And the S&P went down almost 2%. The Nasdaq went down 2.29%. And I bought a little bit of the dip. I'm not gonna lie to you. I dropped about just about $5,000. I didn't spend too much because it's not as big as I would like it to be. 1, 2, 3%. Nothing really much to me. Once it gets into the 5%, that's where I would consider the correction range, where the market is starting to correct, and that's when I would start really putting more money into it. Again, that's just me. If you guys you guys see even a little dip and you buy, there's again nothing wrong with that. I just have my own philosophy, and that's my strategy, and that's what I stick with. I prefer a minimum 3%. I start putting money in when I see 5%, and then once it goes above 5%, that's when I really start dropping more uh, cash to buy the dip. Well, when was the last time we seen a drop like this, right? We actually haven't really seen something like this until I think even April was not like this. I think April actually, um, I don't know if Bitcoin really dropped like that in April, but the drop across broad equities, tech, digital assets indicate a flight to safety. The Dow Jones shed nearly 800 points, and Bitcoin fell below the critical $1,000 uh, threshold. I had to correct myself here. I thought I fact checked myself, but Bitcoin did drop during the April tariff crash. However, it shot right back up basically. But we're not seeing this right now with Bitcoin. All right, the primary catalyst. This was, I think this is what I think it's happening, right? The data blackout crisis. If you guys have been following the news, if you guys are not from the United States, a lot of things have been happening, such as the government shutdown and the Trump administration not releasing data. So I think that was one of the biggest reason why for this drop, right? I think the smoking gun was that um, this is an actual official news title. White House official says October job and inflation data are likely to never be released. And I think that is really, really scaring the market and causing the market sell off, right? This creates a data dark age from the 43-day federal shutdown. And this has not happened. So a lot of this is actually new that's happening right now. No previous U.S. administration have actually ever done this, to my knowledge. To my knowledge, please fact check me on that. I couldn't find actual events like this happening. I think this all what the Trump administration is doing is like new, like way out of place, right? Nobody knows what the heck is going on. Nobody knows what the real data is. Now that they're not releasing it, it could be actually so terrible. Is what the market is reacting to, in my opinion. And then on top of that, now we had the Fed paralysis. The Fed's dual mandate, employment and inflation, is now blinded because they rely on that data. As the Fed is explicitly data dependent, the market is now violently repricing the removal of anticipated December interest cut rate. So now we don't even know if they would do a cut rate because um, of how like Trump is telling all of his federal agencies to just not give anything. I personally think there still might be a December cut rate just because the labor market is so terrible, and that might be another primary catalyst to it's like everything is just being dragged down. Everything is just bad, 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 bad. So there's like no good news right now. Besides that, the government reopened, but then like Trump said when the government reopens, he would release data, but now he's saying, no, I'm not doing it. So it's kind of like, okay, so what was the whole point of the government reopening? How the data paralysis hits stocks. Um, this is how I think it hits it. This is what I think it's happening. November 13th, 2025 today. First, Fed paralysis. No new data means no clear path for a supportive rate cut, which leads to possible higher yields of 10-year Treasury yield spike to a 4.11 rate cut hope fade. That is actual data of the 4.11%, and then that leads to valuation shock because now I'm assuming the market reacts to uncertainty, and so the market doesn't even know where it to place it. Again, this could all be wrong. Tomorrow, Friday, the 14th, it could just do a complete reversal, but I think this is what's happening right now. And then that leads to the tech lead sell off. So you saw all the Max 7 get hit the hardest. You've seen Bitcoin drop below 100,000. You saw the Nasdaq just drop. So everything is just kind of like cycling off of each other. But do not panic. Have a rational rotation, okay? The tech-led drop, the Nasdaq 2.3 drop confirms high growth, long duration assets like Mag 7 are just being hit hardest by rising yields. Again, nothing to really worry about. Excellent companies. Companies shift specific pressure, poor news from Disney, revenue miss, DoorDash, spending concern, and added feel to the negative sentiment. So it's just earnings really missed it, they right now people don't really have the money to spend on these things, so you know it's it's just negative sentiment. And the TEL, which crucially on the New York Stock Exchange, advanced shares outnumbers decliners. And then this is just my conclusion of all three. This signals a rational rotation out of rate sensitive tech and into more reasonably valued sectors, healthcare, industrials, not a sell everything panic like it seemed to be today. And this is why you need dry powder, right? The threefold function of dry powder, right? It helps keeps a defensive moat for yourself, right? It serves as an emergency fund to prevent forced selling of a long-term asset at loss, provides psychological stability to avoid emotion-driven panic, right? When there's blood on the streets, that's when you get greedy. The offensive spear, right? That's what the dry powder is, right? This is the generational wealth function. It is a capital that allows you to capitalize on market downturns and become the strong hand from buying from the weak hands, right? This is where we have the diamond hands. That's when we take away these cheap stocks and put it into our pocket. Right, and then there's just a logistic bread, right? A tactical function provides cash to fund portfolio rebalancing, buy low, and pay for advanced tax alpha opportunities. If you have it, like a Roth conversion. If you have it, I don't. And this is where you build the foundation on these red days. Like I said in the earlier video today, I love the dip. I love red days. When there's red, when I open up my portfolio and I see red, I'm like, I'm licking my lips. I'm like, this is juicy. I love red days because I love buying excellent companies for the cheap, for the low. Because I know these are great companies. They have good strong profits, revenue. They have a moat, right? They're gonna be here for the next 10, 15, 20, 20, 25, 30, 35, 40, 50 years. That's my conviction in them, and that's why I will almost buy them at any price, especially if it goes down. I will buy it. All right, this is my foundation mindset. I hope you guys would have it too, or at least think about it, right? The on sale benefit, I see red days as on sale, right? Buy quality assets at a discount, lower your average cost basis, acquire more shares for the same dollar, accelerate compounding, and supercharge the drips, right? And then this is the market cleansing, right? Corrects frothy vibrations and irrelevant XQ burns. It's just pretty much like the trash companies basically get destroyed, right? It wipes them out, clean them out. It gives us a clearer vision of what the good companies and where they are, because prolonged bear markets, right? Bad companies are not going to survive. Curbs speculation, exposes and wipes out zombie companies and unsustainable business models, right? So this is a good thing, right? Then so the survivors win, and then we want to buy these survivors. The investor foraging, right, provides only true tests of your risk tolerance, and this helps you build your character, your mentality going forward, right? Builds psychological fortitude and teaches critical wealth building lessons of staying invested. When others are panicking, don't panic. They're panicking because everybody else is panicking, and then you're like, well, why would I panic? I have great companies. I buy great cover call ETFs, and these cover call ETFs have great underlyings. In fact, I want more. The only time I'm panicking is because I run out of dry powder. I run out of cash to buy more. I'm like, damn it, I need more cash to buy the dip. All right, this is my tactical playbook, which is pretty much a kind of like a summary of earlier slides, right? Category 1 is just systematic accumulation, right? I'm just gonna drip and dollar cost average. I'm gonna buy. Tax alpha generation, leverage the downturn for advanced tax saving opportunities like tax loss, which I have done already this year. I already have did my tax loss. I purposely um, uh, sold at a loss for $3,000. It's just for tax loss. That's what I do. Activate re-engineering, which is just basically methodically rebalance prune weak holdings, which I do. I keep track of my watch list when I buy the watch list stocks. When I buy them, I'll see how they perform. If they just don't perform the way I like them to do, especially in a down market, they gotta go. They're done. They're out. And that is also, I use them as like a tax loss, right? I learn how they operate. I see how they do, and then it's like, you know what? I don't like it. Goodbye. And I just take that as a tax loss harvest. Not really a loss. Not really an L, right? You learn, and you're like, there's not a good ETF. And then category 4 and 5 is it's just in your head, right? It's logical. And this helped me build my discipline to stay invested, study market history, and focus only on what you can control, and focus on my core philosophy of buying only good companies, good ETFs. And then of course real-time monitoring, right? You have to use actual good products if you want to buy like a subscription on Yahoo Finance to actually track these companies and read up on these companies. Something I personally would advise you to do if you are serious. If you are going to be a serious investor, you want to get to know these companies and understand how they make their money, or how much money they make, or catch up on the latest news as possible, as quick as possible. And then the tax alpha generation, right? Tax loss harvesting, like I said, you can use up to $3,000 per year to offset ordinary income, which I have done already. However, you must avoid the 30-day wash sell rule, right? Please read up on that. This is I'm not gonna get into too much detail, so I couldn't fit all the information. So wash sell rule, just Google it, read up on it, and don't make that mistake. I made that mistake as a beginner investor, so just passing that knowledge on to you guys. And then the on sale Roth conversion, that's if you guys have it. I don't. It just pays ordinary income today on a temporary depressed traditional IRA balance to move it into a Roth account. This event will actually trigger an immediate tax bill, so just be careful on that for anyone that have it. I don't. And then active re-engineering is just basically execute rebalancing, right? It's a forced non-emotional discipline. It forces you to sell high overweight assets and buy low underweight assets. Execute flight to quality, right? Sell weaker speculative B level or B tier companies even at a loss, and then proceeds to buy A level S tier, right? Best in the class. I have videos on that. And then you hunt for moats, right? Buy companies with strong balance sheets and durable competitive advantage that can survive and take market share. And then you go shopping with a watch list. Like I said, I always mention this on a video, right? I have a whole bunch of watch lists. I dip my toes into it when I like the entry point. I don't buy 10 or 20 companies. Actually, I do sometimes buy a bunch at a time, but I will buy like one share if I'm gonna buy that much. Typically, I put anywhere from $1,000 to $10,000, but it'll be like one or two companies at a time. When I buy like 10 or 20, it will be like one share each, and I'll just see how it does, and I'll track it every single day, and well, not every day, right? If it's in a bull market, I don't really need to track it, but when it starts taking the hits from a prolonged bear market, that's when I start tracking it. Generational wealth case study, right? The 2008 to 2009 crisis. Remember the housing crisis? That was it, right? For the people that panic sold, they basically sold at the bottom of 2008, right? And then for an investor who had dry powder during that time, it was a buying opportunity for generational discount. And as you know, from 2009 to now, it was up over 700%. So those who sold lost out on generational wealth, literally. From panic to patient, right? This is not a random panic. Don't panic sell. All right, just if you see red days like those and you don't even have dry powder, just don't log on. Just forget about it. Just put the phone down, right? Don't worry about the uncertainty, right? Because uncertainty is an opportunity, especially if you have dry powder and you had a watch list watch list that you've been wanting to buy, right? The red day is the signal to execute your plan, not abandon it, right? Don't listen to these, don't watch these YouTubers telling you, oh my God, the market is crashing and sell everything. Absolutely not. They're idiots. History is ambiguous, right? Every period of pessimism has been a buying opportunity for those with discipline and dry powder to act. So guys, I want you guys to get rich with me. I want to get rich, right? This is the way to do it. My verdict, right? My verdict, this is a gift. The blackout data is a smokescreen, really, because data is going to be released regardless. So don't worry about this. It's temporary noise creating a rare long-term opportunity while hot money is running scared. This is when we, as strong hands, get to work. We deploy our dry powder, execute the plan. We buy quality on sale. This is not a day to be feared. This is a day to be thankful for. And this is how you win. And this is my summary of the catalyst. I think it was just a data blackout from a 43-day federal shutdown. So people and market money, just uncertainty, and it was just a random sell-off, which wasn't really that bad. And if you zoom out, when in doubt, zoom out, and you look a month prior, 6 months prior. I mean, we're up big time. So don't be scared. Right, the October unemployment rate and consumer price index will not be released, so then that really affects the Fed, right? Which leads to the Fed paralysis, right? So effectively, they don't even know what they're doing. And then the effects of this is a sharp spike in U.S. Treasury yields, triggering a severe valuation shock, especially in the technology sector. So it's just money switching over to T-bills because it jumped up higher. I wouldn't worry about this too much. And that's it. Subscribe, comment, like. Don't panic sell. Don't paper hands. You have a great strategy. You have a great ETF. You have great companies. Keep buying. Dollar cost average. The market will always recover and go up, right? If you're buying great companies, if you're investing in American companies in America, America always wins. I truly believe that. Thanks for watching. Stay tuned. Catch you guys on the next.